These are mission critical types of properties. They do have a wide moat, and they've got a great management team, a great balance sheet.
Even the very best drugs and treatments in the world have patent cliffs, which means, you come up with some cancer curing drug, it makes a ton of money, but the patent only lasts for, say 10 years.
Again, you've got to be very careful in this lodging space. You may recall my business partner ended up basically virtually going bankrupt because he built a hotel in this town I live in.
There's not a better compounder in the market than this company. If you invest in VICI, you own half of the Vegas Strip.
Hi, everyone, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nick Ward. And Nick, it's good to see you today.
Yeah, good to see you, Brad. Happy to be here, and happy to be here for this kind of subscriber-centric episode where we will be just answering questions that people have left in the comment section in our previous videos.
Yeah, I mean, we've had a lot of people going into the channel, and thank you for following us. And please drop us any comments below, because those comments can turn into questions, and we love answering questions and helping investors in all sectors. And today, of course, we're going to talk about some REITs that we have some questions about. So we're going to get going pretty quick because we've got a lot of ground to cover in the literal sense. And so I'm excited to break down a handful of these REITs.
Yeah, most of the questions that we got, Brad, were centered to you. So I think you're going to do most of the talking on this video. With that being said, feel free to ask me questions, guys. I'm happy to answer them as well. The number one on the list that I have here, Brad, I think several people ask about CareTrust. I think probably because of the yield, if I had to guess. But, what do you think about CareTrust REIT? Is that something that's on your radar, or do you like something else better?
Yeah, I mean, actually, it's not as much the yield as it is the growth. I mean, CareTrust has absolutely been a gem in terms of its earnings and dividend growth. But I'm not recommending it today because of valuation. I mean, the company, they've grown. They still have a non-investment grade balance sheet. So they don't have as strong as a balance sheet. But I am going to give you a pick today. But I just want to say, again, it's a good dividend. It's 4.3%, well covered, 74% payout ratio. And again, I like the company because of the growth forecast. They've got substantial growth forecasted in 26. It's going to be 22% growth, so not as strong. And then out in 27, 6%. But in the past, they've had double-digit growth. But again, shares are really trading at a higher multiple today. You can see that fast graph here. Shares are trading at about 18.6 times versus what we refer to as their normal valuation of about 14.8 times. So I would not be interested in CareTrust today for those reasons. A little more modest growth. Again, valuation's a little too frothy for us. I would say shares are a little bit but beyond, I guess, fair value. Now, the company that I like, and we've talked about this quite a bit here on our YouTube show, is Healthpeak, and that ticker symbol is DOC, DOC. Of course, Healthpeak merged with Physicians Realty, which kept the ticker DOC, and so they combined the companies. It's called Healthpeak Properties. Again, ticker symbol is DOC. If you can see here on this chart, fast graph, shares are trading at extremely low multiple, 11.4 times. Again, so the value's there versus their normal valuation around 18 times. So you can see here right on the chart a pretty wide margin of safety here. And of course, that goes hand in hand with the dividend yield. Right now, shares are trading at dividend yield is 6.6%. And actually, they have the same payout ratio, about 74%, as CareTrust. So all things being equal, I think Healthpeak, ticker DOC, has a much better valuation proposition. Not great growth. I mean, they've got growth of around forecast of around 3% this year, 2% next year, and 6% in 27. I think one of the big catalysts for Healthpeak is going to be when venture capital gets active again, because we've had the slowdown in capital in the life science space, and that's created somewhat of an overhang. So we think that eventually will trigger the company, trigger the shares to move forward. But right now, you've got a very safe 6.6% yield. As you can see here on this chart, I think the setup for this is really good. I think we've got an attractive almost 20 to 25% total return, annualized total return setup for Healthpeak. And again, I think it's a very lower risk value proposition based upon the fundamentals as well as the current value of the shares.
Yeah, I mean, higher dividend, same payout ratio, looks like pretty similar growth prospects. So really the major differentiator between those two is the valuation. One of them is trading at a premium to its long-term average. One of them trading at a discount. Makes perfect sense to me as somebody that doesn't follow that area of the market very closely. Speaking of kind of healthcare REITs, another question that somebody had for you in particular, in the past, especially when we talk about triple net lease REITs, we say we love companies that have the fungible rectangles that the Agree Realty focuses on, meaning cookie cutter, square, rectangular buildings. They could be a fast food joint. They could be a bank. They could be a dollar store. They could be a 7-Eleven, etc. It's very easy to replace the tenants. Somebody said, well, Brad, for ARE, Alexandria, which is a healthcare REIT, and then even like a Prologis, which we've talked about with the massive, big industrial buildings, how does that, factor into your bullish stance? Because those are not fungible rectangles. So can you speak about, why you like companies like ARE or PLD, even though they have, pretty unique real estate footprints?
Yeah, I mean, look, I think, a lot of companies, they love using this name mission critical, and of course we saw that with medical property trusts, right? Hospitals are mission critical, but we've seen, slower demand, slower supply within the hospital sector, and a lot of companies that have had financial troubles in the hospital sector. Now, in terms of Alexandria, I think the company is well positioned. We certainly aren't going to see the stronger demand that we saw in previous years. Analysts have consensus of around minus 2% this year, just 1% next year, and out to 5%. But again, I think what will trigger the life science sector is kind of a return of venture capital to this space, and we'll have more demand. But obviously, Alexandria owns some of the best life science properties, some of the best markets. And I could argue that these are mission critical types of properties. They do have a wide moat, and they've got a great management team, a great balance sheet. So I think Alexandria will definitely be able to navigate, these kind of tough times we're seeing right now. Now, in terms of Prologis, it's the same thing. These warehouses are actually mission critical properties for a lot of companies. If you look at their top 10 or 20 lists, they've got Amazon at the top and a number of big corporations that you would recognize. And they're a global player as well. So I think Prologis, again, these are big boxes. I prefer in the industrial space, I know I've mentioned this in the past, East Group, which has a smaller footprint. Their average building size is about 100 to 150,000 square feet, and they divide up those sections with multiple tenants. I like that model a little better in this current environment, but look, I think these are really good picks, and we'll be talking about one industrial pick here in just a minute.
Yeah, and before we move on, somebody did ask me about biopharma companies, healthcare companies, the Johnson & Johnsons, the Amgens, the Abbeys, the Mercks, et cetera of the world, kind of our thoughts on that at Moat and mine in particular. And it's funny, I used to be known as a healthcare analyst on tip ranks, back in the day when I really paid attention to that. They look at all your picks, they tally up your results. I was doing very well in the healthcare space. And I personally have made a lot of money trading these stocks and investing in these stocks. When I say trading, I don't do day trades or anything, but I've made a lot of money with them. But now I'm kind of totally out of this sector because I've realized I don't know that a healthcare company, a biopharma company, can have a wide moat. Brad and I talk about that so much over the years. I've kind of transitioned to that being a higher and higher and higher priority for me when I'm thinking about the companies that I invest in personally. And the issue is it's not capital. It's not human capital. There's very smart people working at these companies. They have a lot of money. They make a lot of money. But my issue is even the very best drugs and treatments in the world have patent cliffs, which means, you come up with some cancer curing drug, it makes a ton of money, but the patent only lasts for, say 10 years. At the end of that 10-year period, that drug, any company in the world can make a generic version of that drug and undercut you massively on prices. So it makes predicting long-term growth pretty difficult. I don't have a PhD in chemistry or biology or any of these things. I can't look at these presentations that the companies put out for their phase 1, phase 2 drugs, look at the science, look at all the molecular data and know, hey, that molecule is better than this molecule. It's not something that I can do. If you can do it, more power to you, and you should probably invest in this space. I can't. So I just avoid these stocks now. It's a pretty easy decision for me. There are hundreds of great companies in the world. You don't have to own all of them. So that's my take. I don't know that I can call any company, even Johnson & Johnson, wonderful company. It's been raising its dividend for 63 years. Very reliable earnings growth. They've done all the right things, but their business model requires for them for every few years to go spend 10, 20, 30, $50 billion on M&A. And if that ever doesn't work out, then there's going to be a problem. So that's my issue with the space. That's why I avoid it. Healthcare has been a conservative, kind of defensive dividend growth area of the market for decades, and it probably will continue to be, but I'm pretty content to avoid it. So maybe that's not what you wanted to hear. I forgot who asked that question, but that is an answer that I'm happy to give. But so now we're done with healthcare. That was a lot of healthcare questions, and it doesn't surprise me because that area of the market is out of favor right now. It's one of the worst performing sectors year to date. Now we're going to move to another area of the market, very different. Brad, somebody asked you about your thoughts about hotel REITs, about the lodging sector. So what do you think? Is that an area of the market that you like or that you avoid? And maybe do you have a favorite in that area of the market?
Yeah, so this is my top pick in lodging right now. Now, keep in mind before I give you that pick, lodging is extremely volatile. Lodging REITs have always underperformed in recessionary markets. So you got to, to me, if I'm looking at buying lodging REITs, I would always look at this through a speculative lens. We saw what happened during COVID. But I like this company, Ryman Hospitality Properties. Now, they're unique from any of the other lodging REITs because they invest in upscale convention center resorts and entertainment experiences. So what they target is meeting space properties that drive revenue all under one roof. I don't know, Nick, if you've been to a Gaylord property. I've gone down to the Money Show quite a few times, and that event was held, I don't know if it still is, in Orlando at their property there. They call that the Gaylord
I have hotel. Not. I go to Orlando once a year at least, but we're staying, at the beach club or the wilderness resort at Disney World. So now I'm kind of my Orlando experience is pretty closely tied to Walt Disney World.
Yeah. Well, they've got 5 of the top 7 largest non-gaming convention center hotels. And when you go to those hotels, you don't have to go anywhere. You can Uber in from the airport or you can rent a car and you can just stay there for 3 days or a whole week and not leave the place. They've got, obviously dining in there. They've got spas in there. You have your conferences in there. It's a really cool setup, and they've really mastered the art of this convention space. So that's number one. Their portfolio has 11,414 keys and 5 of the top largest U.S. non-gaming hotels by meeting space. Now, in addition to that, they own a 70% controlling interest in Opry Entertainment Group, which is a taxable subsidiary. I don't know if you've seen or heard about Opryland, but that's one of their brands, and they generate revenue under this taxable REIT subsidiary. I'm going to pull up a map here, and you can see all of the markets they're in: Denver, San Antonio, Dallas, Nashville, Orlando, and Washington, D.C. Those are all attractive markets for conferences. Now, I'm pulling up this next slide or fast graphs. You can see that during COVID, just like all of the hotel REITs, demand just fell to zero. And you can see that during 2020 and part of 2021, the shares sold off. They went to negative earnings. There was nobody renting hotels or attending conferences, as you can imagine. But what's interesting, and you look at this fast graph, you can see the company has returned to their normal pre-COVID levels. In fact, they're still surging there. So they have been able to really thaw back from this COVID-19 and generate shares and dividends over some pretty interesting levels. So they have generated something like 7% dividend growth since inception, which is around 2012, even during that COVID period when they sold off. But what I like about this company, they have the highest growth business model of the other REITs. They're generating double-digit growth in 26, their analyst estimates, and 27. They're down a little bit this year, but I think overall, I'm very bullish with this company. The dividend yield is 4.4% with a price to AFFO multiple of 12.4. Now you compare that to normal valuation of about 14 times. So definitely trading at a discount. You can see that here on the chart. And also, I think the setup is really good. This company could generate somewhere in the range of 25% annualized by the end of 2026 as those growth catalysts kick in. Again, you got a very safe 4.4% dividend yield. You've got growth, and again, a return to kind of a normal multiple. So I like that one the best. But again, you've got to be very careful in this lodging space. You may recall my business partner ended up basically virtually going bankrupt because he built a hotel in this town I live in, and that impacted me considerably. So obviously, I'm very biased, kind of against hotels. But if I'm going to invest in a hotel, I like Ryman Hospitality the best.
Yeah, no, that sounds like a great pick. I like that convention center. Another stock we're going to talk about in a little bit, and I'll give a little spoiler. Somebody asked about VICI. that's such a big part of their business model too. These huge, convention center hotels where you can have, 20, 30, 50,000 people all there for a reason. Obviously, that's a lot of revenue. Before we move on, in this space, I don't follow the REITs so much, but I do look at a couple of companies that have lower yields but very good growth profiles. And that's Marriott International. Everybody knows about Marriott hotels, and then Booking.com, which is kind of the best digital platform for booking hotels, travel, air flight, anything you want to do. You can, now with their AI systems, you could basically say, hey, Booking, I want to go to, Fiji for a week and I want to do it on this much money and this is what I want to eat. And they'll do it for you. And I think that's pretty cool. Here's a fast graph of Marriott. And as you could see, just like Brad said, during 2020, they dropped 97% earnings. They went from $6 in earnings in 2019 to 18 cents in earnings in 2020, right back up the next year to 669. So yes, a terrible kind of break of the trend during COVID, but everything has continued to a nice up and to the right swing since then. Their dividend was cut in the COVID. So that's kind of, I don't own Marriott. And that's because of this dividend cut, it kind of doesn't pass a lot of my personal screens. I hate seeing dividend cuts. And it takes a lot for a company to overcome that when I'm comparing it to all the other things I could invest in. But if that doesn't bother you as much, their dividend now is much higher than it was in 2019. So they not only did they reestablish that dividend, but they've continued to grow it every year. You can see that on the yellow line at the bottom of this fast graph. And while 2024 is expected to be a tough year, analysts are calling for 7% growth next year and then 12% in 2026 and 2027. So really strong fundamentals for Marriott, kind of a best in breed brand in the hotel space. So that's where I would go. I don't even know. I don't look at this company closely because of that dividend cut. I don't know if they own the properties or if they kind of rent them out. This may be a primary real estate play. That's something for somebody to pay attention to if you're doing your due diligence here. But I say I don't own it because my focus, and let me figure out the fast graph here, in this space is Booking Holdings. Here's the chart. Why is that? Because outside of 2020, where the world shut down, negative 95% EPS growth, they've given double-digit earnings growth every single year for basically decades. There's not a better compounder in the market than this company. Right now, there's a worry that, hey, AI is going to disrupt them. And, do you really need Booking.com? If people don't go to Google, are they not going to land on the blue links that lead to Booking, et cetera? Well, Wall Street's not scared. They're calling for 16% earnings growth this year, 14% next year, and then 16% the year after that. The stock's trading for 28 times. So that seems expensive, but it's not that bad when you're talking about 15 to 20% earnings growth. It doesn't take very long, even when you're buying at a high multiple, for the earnings growth to not only justify that valuation, but to justify big gains. So I'm up big on this position. I've owned it for a few years. It took forever for me to have the opportunity to buy shares because it's an expensive company most of the time. But as we saw a dip the other year, it fell down to about 20 times earnings instead of kind of the 30 that it trades at. You can see on the fast graph, what was that in 2022? There's a big dip. I took advantage of that. Now I'm just happy to hold these shares. So they recently established a dividend last year. They begin paying. So it's going to take a while, but hey, in 25 years, I think this could be a dividend aristocrat with the type of profit metrics that they have. So Booking Holdings and Marriott International, if you ask me about the hotel space, that's where I'm looking. But I think, Brad, your Ryman pick was pretty interesting. The 4.4 yield is not what I need right now, but there will become a point in time in my life where that is my main focus. And I could definitely see that being the top pick in this space because of the yield. Now let's move on. So VICI's up next. A perfect transition. I think several people have asked you about VICI. That's something that both of us have covered very closely. I'll let you talk to it. You know more than I do. But yeah, that's been a big winner for our wide moat letter portfolio. Our subscribers know that, and I provide regular updates for them. But now's a chance for you to let everybody else know, what are your thoughts on VICI?
Yeah, so we've been covering the company really since before they listed in 2017. The history really goes back to Caesars. Caesars went through bankruptcy. And in 2018, they took those assets, those Caesars hotels, and put together a net lease business model. And VICI owned the Caesars property. So they seeded the portfolio with Caesars properties. That was, again, 2018. And since that time, they've diversified this business substantially. They grew to S&P 500 status probably quicker than any REIT that I know of. And that IPO in 2018 was one of the largest IPOs in REIT history. I think it's the fourth largest IPO. So now they've got a considerably diversified portfolio. It's mostly casinos, but they've been expanding into other alternative experiential properties. Now, I want to address the mission critical element of this because you think about it, you got to look at the business. If you invest in VICI, you have to ask yourself, do I want to own this? Do I want to own Caesar's Palace?
Just to be clear, we'll throw up a chart now. If you invest in VICI, you own half of the Vegas Strip. Yeah, and that's not an exaggeration. This company owns, probably more than half of the prime time blue chip properties in Las Vegas, and so that that's what we're talking about, the best in breed gaming landlord in the country.
Yeah, I mean, 10 trophy assets, all in Las Vegas. Many have asked, why isn't this a monopoly? Well, the reason is they don't operate this business. What I like about this is there's no operations at all in their business. Everything is net lease based. In addition to these 10 trophy assets in Las Vegas, they also own 660 acres of raw land in Las Vegas, 41,400 hotel rooms. Again, that's all net lease. They don't do any operation. They just collect rent from these landlords. So you got to ask yourself.
Just to be clear, too, we talk about this, but net lease is our favorite, right? What does that mean? It means they don't have to. Their tenants, the Caesars of the world, they pay for taxes, they pay for maintenance, and they pay for insurance. So
you just talked about
not on the hook for any of that.
Yeah, you just talked about some of these healthcare companies like Johnson & Johnson and others. So it's been a very choppy kind of setup for them, right? And so with net lease, this is very stable, very predictable income because they're long-term contractual leases. And that is one of the primary competitive advantages of this mission critical business model. Their lease is around 40 years. And what's really interesting is during COVID and looking at the hotel sector, every hotel REIT were just like Ryman. You saw those earnings drop. You saw those dividends suspended. It was a very difficult time for anybody in the hotel sector or in the travel industry in 2020. But guess what? VICI continued to collect rent, 100% rent collection. So, and I kept pounding my hand, on the table during 2020. I'm like, look, I know you're scared to death, but there's Caesars and MGM and all of these other gamers are still paying rent, and they're going to continue to pay rent. They've got balance sheet that can support this through COVID. And so they've done. That's
and they can't afford to lose those properties, right? If Caesars loses Caesar Palace, well, MGM's going to come and take it away from them, right? They know if they stop paying rent, somebody else will take those trophy properties, so they can't do it. It's not an option.
Well, another big part of this business model, again, part of this mission critical moat, I'll call it, is they have a large percentage of CPI-linked escalation clauses. So that means they still grow even in this inflationary environment. We had a slight tick up today, obviously, in inflation, but they're growing that portfolio. By the end of 2034, they'll have 90% of their leases CPI linked. So that's huge. The other thing I like about VICI, the management or G&A is extremely low. It's actually the lowest in the whole REIT sector of about 1.5%. So it doesn't take a whole lot to manage, this portfolio. As I said, they've got mostly casinos in the portfolio, but they've expanded into other categories as well. So they're in like the healthcare space, amateur sports, water parks, bowling alleys. So they try to diversify this revenue. And they've also put together kind of a finance model where they'll do some like mezzanine lending to some of these qualified companies, and that generates a higher yield. So it's kind of a yield enhancement piece of that business. And eventually they would like to own those properties. That's their plan. They like to loan to own, if you will. So the balance sheet is in great shape. Again, it only took a few years for them to grow this balance sheet. Right now, they've got a BBB S&P rating at S&P Moody's and a Baa3 with Moody's and BBB minus with Fitch. So a very strong balance sheet, 5.3 times net leverage. So they've been able to maintain very conservative leverage. They've been able to grow. And right now, in terms of shares, I'm putting this fast graph up again, they're trading at 14.5 times. Normal valuation is closer to 15.4. So it's not a huge margin of safety like we saw with Healthpeak or Doc, but it is trading at a discount. We would definitely recommend, an allocation to VICI for those reasons. The dividend yield is also attractive at 5.2% with a payout ratio of around 75%. So well covered, great management team. We've interviewed them quite a bit. I'll be going to Las Vegas soon. I'm working on another assignment for Wide Moat Confidential. And it's great to kind of boots on the ground to see what's going on because you're really making an investment in Las Vegas, which is one of the highest growth markets, in the country, with all the new sports venues that have come there. And so I definitely am very bullish with VICI. I think there's definitely more room to run. As this next fast graph shows, we think the potential opportunity. Now, they got fairly modest growth this year, about 4%. We'd like to see that 5% number. But even with that modest growth, we think the total return prospects is about 15% on an annualized basis for VICI. So it's definitely still a buy. And again, I do consider these mission critical assets.
Yeah, I mean, hey, you say the old saying goes, the house always wins. Who better to have as a tenant when you're a landlord than casinos, right? If they're always winning, they're always printing cash, they're happy to pay you cash. So I like that too. And I like that CPI that you mentioned, 90%. A lot of people that I talk to, they're worried about inflation and even hyperinflation. They're worried, what do? We buy Bitcoin? Do we buy gold? Well, maybe VICI's the answer, right? You get your high yield now in the present, and then if inflation takes off, well, guess what? Their earnings are going to take off too. So that's something to think about for the people that are really trying to figure out how to position for higher inflation, if that's what you think is coming down the road.
Yeah,
Brad, the next question. Oh, go ahead.
Yeah, I was going to say, no, casinos, fairly new sector, but we've seen there's another casino REIT called Gaming and Lodging. And then some of the REITs, Realty Income, have also invested in the gaming sector. So, we're going to see more and more of that over the years. One of the sectors that we're going to talk about next is also a fairly new sector in the REIT space, which is the cell tower sector.
Yeah, you beat me to it. Cell towers, it's not a specialty of mine. I'll pass this one to you. People were wondering, what do we think about cell towers? If I'm not mistaken, there's really only two players, right? It's American Tower and Crown Castle International. Those are the two, just kind of a duopoly in this part of the market.
Well, actually, there's three. There's SBAC Communications. Actually, my cousin works there, and he runs he works at their Costa Rica facility. So, which is a great job for somebody right out of college.
He's got life figured out. Good for him.
Yeah. But let's first talk about American Tower. But before there, I'm going to drop this chart on you real quick. This chart I put together recently shows the performance really from 2015 to 2024 of what I call the tech trifecta. We have industrial, we have data centers, and we have towers. And over these years, you can see that these sectors, all linked to technology in some form or fashion, have returned average returns across those sectors of about 13.4%. Towers is around 10%. Data centers, 16%. And of course, in the last few years, data has been an unbelievable 30% returns in 2023, 25% in 24. And then industrial as well. So anyway, I think towers, I would definitely recommend, kind of an equal weight or an overweight position among the tech trifecta. Now, the next chart I'm going to show you actually shows all of the companies that are industrial companies, that are data center companies, and cell tower companies. And I've highlighted those three at the bottom: Crown Castle, SBA, and American Tower. You can see year to date, they've actually done really, really well. They're one of the top performing sectors overall. Crown Castle's up about 13%. Now, this was done about a week or so ago, so it's not been updated. But still, you can see a lot of green in the cell tower sector. Now, Crown Castle, we've done a lot of research on Crown Castle. We've covered them for years and years. They recently cut their dividend, and we knew this was going to happen because they were talking about selling off their fiber business, and they actually did that. They received about $8.5 billion for the sale. They sold it to Zayo Group Holdings and its small cell business to EQT Active Core Infrastructure Fund. So they basically have lost a good bit of revenue. Thus, they cut that dividend by 32%. Again, we forecasted that. We knew that dividend cut was going to happen. And again, I much prefer American Tower for a couple of reasons. And I'm going to show you this chart here of American Tower. American Tower is cheap. They're trading at 21 times. Not extremely cheap. Their normal valuation is close to 23 times. So again, I think definitely in the buy zone, I would say, with American Tower. I also like the fact they've invested in data centers. They own a portfolio of data centers, which links and definitely complements their global, although the company says American Tower, they should call themselves Global Tower Company or Corp, because they invest globally in a lot of different markets. And again, they have this data center business as well, which is extremely powerful. Now, the growth of the company this year is relatively flat. But again, 26, we're seeing analyst consensus of 7%, 6% for 27. They actually have generated closer to double-digit growth over the last few years. But again, that growth is still very stable. They have a very strong triple B balance sheet, again, very strong. Their payout ratio is also very strong as well. And so I like American Tower a lot. We think the forecast for that company is somewhere around 20% annualized for this company. Crown Castle just has a lot. I mean, they're basically, building Crown Castle 2.0. So I'm kind of waiting to see, when are we going to recommend this company? But right now, I think, American Tower has proven it's much better capital allocator, and they've been providing investors dividends for quite a long time. So I definitely consider American Tower the favorite over those three companies in the cell tower sector.
Yeah, it's funny because, we talk about companies trying to kind of skate where the puck's going instead of where it is. And it looks like AMT just won the race with regard to their kind of diversification into the data center space. Instead of Crown Castle going into fiber and kind of small scale, they were going into different methods of distribution. AMT focused on the cell towers, the old fashioned business, and data centers. They made the correct bet, right? It's as simple as that. Their data center business is very lucrative. The small cell and the fiber stuff for CCI, I think it's probably right to call that a failure to a certain extent. And we're happy that you like AMT. It's been a great pick for you. It's been a great pick for our subscribers at the Wide Moat Letter. So and I think we're right at 30 minutes, Brad. So pretty good way to end this video. I know there's more companies on the list of questions, so we'll keep track of this list. I update it every week. Keep asking us new ones, and we'll make sure we'll get to all of them eventually. We're not like short-term investors. If you miss one for a week or two, it's okay. I'm sure the companies will be there in the future. So please, like and comment and subscribe to the channel, and we'll be happy to answer your questions in the chat section and also in videos like this moving forward.
Great. Thank you, everybody, for watching, and we'll see you next week.
Yeah, thank you, guys.
Thanks for watching this episode of The Wide Moat Show. Please like and subscribe below. And also, please join us at the Wide Moat Daily for our dose of daily news. You can visit us at widemoatdaily.com. Thanks for watching us. Have a great day.